Hello everyone. Today, we're going to learn how to use the Bybit exchange. You'll find the link to Bybit in the description below this video, so please check it out. Now, let's go step by step and learn what you need to start futures trading on Bybit. At the top of the Bybit website, you'll see a menu called Trade. Inside this menu, there are several options. Spot trading is similar to regular stock trading, but today we'll focus on futures, which you'll find just below spot. Inside futures, there are several categories, but the most important one to know is USDT at the top. USDT futures mean you're trading Bitcoin using US dollars. There are other options like USDC, but if you're new to futures trading, it's best to start with USDT futures. Below that, you'll see Bitcoin, Ethereum, and many other commonly traded coins. Let's click on Bitcoin. Once you do, the chart will appear, and on the right side you'll see the trading panel. You can see trades happening in real time, along with everything you need for futures trading: leverage, position size, the long button for upward moves, and the short button, which many beginners are curious about. First, let's talk about leverage. Click the leverage option in the top right corner. You'll see several settings, but the two most important ones are isolated and cross. Let's assume you're trading with $1,000. With isolated margin, if liquidation happens, only that $1,000 is affected. In other words, you only lose the amount you initially invested. With cross margin, your entire account balance is used as collateral. If you open a long position and the price drops toward liquidation, the position doesn't close immediately. Instead, the liquidation price moves lower, and liquidation happens only when your entire balance is exhausted. If you're new to futures trading, isolated mode is strongly recommended. Even if liquidation occurs, you'll still have remaining funds to trade again. So when should you use cross? With isolated, liquidation happens at a fixed level. With cross, the more assets you have, the lower the liquidation price becomes. For example, you might trade with $1,000, but if you have $100,000 as collateral, Bitcoin could drop by 50% and you still wouldn't be liquidated. However, if a massive crash happens, you could lose everything. That's why cross mode is only recommended for traders who can manage risk very carefully. If you're a beginner, select isolated. Now you'll see the leverage slider, which allows you to choose how many times leverage you want. To make this easy to understand, I'll explain without fees. With 100x leverage, a 1% drop means liquidation. With 50x leverage, a 2% move can liquidate your position. With 20x leverage, a 5% move does the same. Anything above 20x is considered high leverage. The most commonly used leverage is 10x, which allows about a 10% price movement before liquidation. With 5x leverage, you can handle around a 20% move. Lower leverage means more stable trading. You might ask, why not always use low leverage? The purpose of leverage is to aim for larger returns with smaller capital. With 100x leverage, $1,000 controls a position worth $100,000. If the price moves up just 1%, you can make $1,000 in profit. With 10x leverage, a 1% move results in about $100 of profit. But remember, higher profit always comes with higher risk. If you want higher leverage and can cut losses within 5%, around 20x may be reasonable. If you're new to futures trading, start with 10x or less. Below leverage, you'll see limit, market, and conditional orders. Limit orders allow you to set a specific price, and when the market reaches that price, your order is executed. Market orders execute immediately at the best available price. The biggest difference between the two is fees. In futures trading, limit orders usually cost around 0.04%, while market orders can range from 0.07 to 0.1%. With frequent trading, this adds up quickly. There's even a saying that using 100x leverage and trading repeatedly can wipe out your account just from fees. Even if you invest $1,000 with 100x leverage, fees are charged on a $100,000 position. In fast-moving markets, market orders are often necessary, so avoiding excessive leverage is very important. If fees feel burdensome, many exchanges offer fee rebates. Recently, some exchanges refund around 20 to 30% of your trading fees. If you sign up using the referral link in the comments, you can receive a portion of your fees back every Monday. Now, let's talk about conditional orders. Conditional orders are trigger-based orders, where you set a price and quantity in advance. With limit orders, the trade executes when the price reaches your target. With conditional orders, the trade executes automatically once a specific price level is broken. Conditional orders are especially useful when you expect a breakout, or don't want to watch the chart constantly. For example, you can set it so that when price breaks above a level, you automatically enter a long position, or if price drops below a level, you automatically enter a short position. Once you get used to conditional orders, you can trade without staring at the chart all day, often called sleep trading. Next, let's look at long and short. Long means you profit when the price goes up, and short means you profit when the price goes down. There's a very useful feature here. If you click TPSL, a new window opens. TP, or take profit, lets you set a price where profits are locked in automatically. SL, or stop loss, lets you set a price where losses are cut automatically. Before entering a trade, you can already see your expected profit and loss, which is extremely helpful. Let's try a long position. You'll see that TP and SL are applied exactly as entered. After entering the trade, you'll see detailed information at the bottom, including the asset, leverage, position size, entry price, average market price, and most importantly, the liquidation price. You'll also see your current profit and loss, as well as realized profit. At first, you may notice a small loss due to trading fees. If you partially take profit, the realized profit updates accordingly. Because TP and SL were set, you'll also see your reserved exit prices, and you can modify them at any time. On the far right, pay close attention to the market option. When closing a position, enter the quantity, confirm the trade, and the position will be closed. Many mistakes happen at this step, especially when trading multiple assets, so using this correctly helps prevent closing the wrong position by accident. If you followed along this far, you now understand the overall flow of futures trading. It may feel complicated at first, but with practice, anyone can learn it. Just mastering the features we covered today can greatly reduce unnecessary mistakes. If today's video was helpful, and you want to trade crypto properly, check out the recommended videos for the latest exchange guides and useful tips. Thank you for watching.